Welcome to TheoTrade. This is Don Kaufman. You are watching the Theo Weekend Update for September 8th, 2018. Let's get started with that the markets fall right on the edge. Let's quantify precisely what that happens to mean. For those of you that do tune in on kind of a week-to-week basis, even a day-to-day basis, I talk extensively about expected move. What that ultimately is, it's the option markets kind of quantifying risk in the week to come. Now, in the SPX, this past week, which was a 4-day, it was a holiday week, right? Came out of the holiday into, well, it's a September volatility, but the holiday week had right around a $30 expected move. In a moment, when we get to the charts, I'll show you again, kind of the specifics and really get into kind of quantifying this more in depth. So it's about a $30 expected move, okay? The market fell literally on the edge. Now, again, you gotta wrap your arms around this. The SPX is a $2,870 behemoth. It missed the lower edge of the expected move by under 40 cents. Like 40 cents in a $2,871 product is absolutely astounding. So what this kind of entitles us to say is that the marketplace is still displaying efficiency. That is, we stayed inside of the expected move. We're now moving on to like 3 out of the last 23 weeks. Only 3 out of the last 23 weeks have we actually breached the SPX expected move. So when we talk about markets falling right on the edge, that's really what we're kind of depicting. Now, another aspect of this is last week with a 4-day week, we had right around a $30 expected move. Well, guess what? Let's talk about this next week, because what matters is not what just happened in the past. Forget about tech. Let's not talk about Apple. Ooh, they're going to have a new iPhone this week. I've seen one of those before. But let's talk about the markets and the structure as a whole, again, kind of moving forward. One of the big and key differences this next and coming week happens to do specifically with the SPX. Why? The expected move moved from 30 bucks, and this next week is going to be 42. So for those of you that are kind of tuning in here on this weekend update, hey, listen, you want to tune in and turn on to this marketplace throughout the course of this next week. Why? Because it's telling you that the markets are going to be rocking a lot more than they have, because we haven't had a $42 expected move now in quite some time. You actually got to go back all the way into, like late July when the Nasdaq looked like it was going to tank at that point in time. So enough with the SPX. Again, we're going to show you here in the charts in just a moment and really kind of dig down deeper into that. What we want to look at kind of moving forward, there's another aspect when I talk about, markets falling right on the edge, and that has everything to do with the bonds. So I'm going to show you here in detail in just a moment a little bit about the yield curve itself, okay? Because the jobs number came out on Friday, and it came out hot in terms of wage growth and so forth. When I say, again, it kind of came out hot, it was much better than had been anticipated. And what happened is the 2-year, in terms of there's bonds, there's notes, there's all kinds of different paper out there. Listen, U.S. Treasury debt, if you'll buy it, they'll sell you anything. But the 2-year took off to the downside, which the interest rate associated then took off to the upside. And we're right on the edge of an inflection point where it looks like the yield curve could actually invert a little bit. And again, I'll show you that here momentarily. So when you're looking forward to this next week of trade, there are a couple of major factors. Obviously, you want to, hey, rest assured, hey, if tech pulls up, we'll be okay. Not necessarily so. This marketplace is not all about tech. You just had interest rates. All right, this past week, the interest rates went up. Financials, though, however, did not. So what we really want to look for this coming week, all right, correlation in the markets. We haven't really had it. That is, I want you to look at the S&P 100, and I want you to see, are the stocks moving in unison, or are we still broken? Earlier this week, we had 60 stocks up, 40 stocks down, but the S&Ps were down, and down considerably, at portions of the day. So we had a positive advance decline line, but the market happened to be down. We want to look and see if the markets are going to get correlated throughout the course of this week. It's actually a very distinct sign of more extreme volatility. The other aspect, and this one is, I think, absolutely crucial. Bonds versus S&P. Are they going to move in the same direction? And what I want to get into, again, that detail there is if the bonds, again, really start to sell off, is the S&P going to sell off with it? Because that would be a wild picture. Why? Where are you going to run to? You're a fund manager with billions of dollars. Where are you going to run to? What risk assets are you going to run to? You're going to dump money, what? Over to volatility? Are you going to buy the US dollar? And again, we're going to show that here. With that, well, let's get to the charts.
So let's talk a little bit about the SPX, the market as a whole, before we get into some detail surrounding some of the bond trade. What I like to discuss in a bit more extent happens to deal with expected move and kind of efficiency in the marketplace. So I'm giving you right now a zoomed in view of the SPX. And what I wanted to show you, again, these expected moves right in here, okay? This central line indicates that's where we started in the week. The upper line is the upper band of the expected move. The lower line is the lower band of the expected move. I'll give you an example in the past. Let's say that this expected move was $31. Now that means the market's capable of moving about $31 higher or $31 lower. That's not a number that I came up with. That's what the option market kind of depicts the risk to be. So 2 weeks ago, what did we do? We actually closed right on the upper edge of expected move. I mean, like to a T, pretty much we're on the upper edge of the expected move. This past week, we had right around a $30 expected move, higher or lower. Now remember, it was just a 4-day week. So there's 1, 2, 3, 4 trading days. Where did we close? We closed, again, within 40 cents on the edge of the expected move. Now, the reason that I like to kind of delineate this is it's incredibly important, but it has everything to do with what I term efficiency or inefficiency in a marketplace. And what I'm showing you here, you can see some little highlighted areas, and I'll kind of zero in there, that highlighted area, this highlighted area. Those highlighted areas are if we close at the end of a week outside the expected move. And I watch that very, very carefully. Why do I watch it carefully? Because it would be a display of, if you will, inefficiency in a marketplace. It's basically the marketplace is completely and utterly breaking apart if we continually close outside of expected move. Now, this happened to actually be in January. We were breaking apart to the upside before we broke apart to the downside. Okay, so I think that people are now starting to realize like why I start to watch this thing so carefully. Volatility, when people look at volatility, they're like, oh, the VIX. Okay, forget about the VIX for a second. When the market starts to get inefficient, that is the option market, all right? If the option market is doing a really poor job of pricing risk, then the market itself is actually continually breaking outside to the upside or to the downside of these expected moves on a week-to-week basis. We just haven't had that recently. I mean, this is going back now. And again, I'm just zoomed in right now to the most recent. That's 23 weeks of data. From here to here is 23 weeks of data. And we've only had, again, 1, 2, 3. And by the way, 2 of these are so mild, they're almost rounding errors. That's 3 out of the last 23 weeks that we've actually broken outside. So you're starting to get into, I mean, like, again, how often are you supposed to be inside the expected move? Well, 68% of the time. How often are we inside the expected move? You know, we're upwards of like 87, 88, percent of the time right now, we're inside the expected move. And again, we can look back over umpteen weeks in terms of a data set. So what I would anticipate, okay, is if volatility is really going to hit hard, it's going to be shock and awe. And we just have not seen that, okay, in really any recent trade. So I wanted to kind of elaborate upon that before we really got going about the market as a whole. So now let's kind of quantify and talk a little bit about the markets. Let's turn off the expected moves for just a second and zoom in. So we're getting some sell side activity. Okay, and again, people get a little bit alarmed about this. I don't think it's necessarily anything to be alarmed about because, again, it's been incredibly orderly sell-side activity inside of the S&Ps, right? We slid down this week, and what did the S&Ps really lose, week over week? Well, we lost $30. Basically, we lost what the expected move happened to be. Neither here nor there. But that slide has amplified volatility quite considerably in the marketplace. But, I kind of feel like everybody's focus right now, they're not looking at the S&Ps, okay? They're not looking at the S&Ps. Listen, people, we're still less than a stone's throw off the all-time highs. Like, let's not get crazy over here. We're still stone's throw off the all-time highs. But as I pulled up now the S&P futures, I want to keep you kind of mindful of a very, very specific level because we're not too far off, okay, one of these key levels, and that key level is right in this neighborhood here. And it's been a little while since we've talked about it, okay? But it's 28.42. So if you take a look at the S&P futures, they're at 28.72. If we were to sell off a little bit, I would not be surprised at all if we got sucked right into the 28.42 at a point during this week. So kind of keep that in mind as the week progresses. And it is worth like putting that line on your screen. All right. It's just a very, very key inflection point from all the way back in the January, February kind of sell-off time. It's been incredibly important in most of this summer's trade. And now, once again, we're about 30 handles, just about 30 S&P handles away from that, again, 28.42 level. Now, I kind of feel like everybody's head is, stuck in Nasdaq land. So the Nasdaq saw some sell-side activity. Either you're looking at the Nasdaq, right, or you're looking at Tesla. Ooh, come on. Everybody likes a little bit of a train wreck. You know, it's not even so much the Nasdaq right now that's getting the sell-side activity as it is what we term the monsters of tech. Now, on a percentage basis, this move, and I'm just going to pull this up on a year-to-date percentage, is barely even of significance at this point in time. Just to make a quick and dirty kind of point. If you look at this, we moved up almost as fast as we moved down, which is unusual. So we're just throwing off a little bit of volatility in there. Now, for those of you, if you're getting into like premium selling and so forth, all right, you can look over at the Nasdaq, and right now the Nasdaq volatility has actually picked up, but I just want to, douse your expectations over here. The IV percentile is the 34th percentile. You're like, what? What does that even mean? Okay, the Nasdaq volatility isn't even at 20%. So we just saw all this sell side activity, and on a percentage basis, ooh, scary. But on a percentage basis, all right, volatility was like, I'll get there when I get there. And quite frankly, my focus is less on the technology underlyings. My focus is much more on, again, kind of market as a whole. I haven't taken a ton of technology positions. Why? Because I deem them extraordinarily difficult, especially on a day-to-day basis, to kind of really, grip a handle around them. Whereas, specific underlyings like, some of the financials or a Caterpillar or a Boeing have been a little bit more, routine for us. Anyway, moving forward, okay, I'm less inclined to look at the Nasdaq, and I'm much more inclined to look specifically at the S&Ps and their reaction, okay, and where they're going to be moving forward. And the reason I'm so inclined to do that is just look at the advanced decline lines. Again, the advanced decline lines in a lot of recent trading sessions, this is the S&P 100. All right, so the S&Ps ended down 6 in the day, the Nasdaq. Okay, the Nasdaq tried to rally throughout the course of the day, it fell back, but the advanced decline line is anything but correlated. And this one, it just screams like, we have bigger issues. And one of the bigger issues we have is you just saw the S&P sell off 30 points this past week. And the advanced decline line, though, it hasn't been bad at all. In fact, on certain days, the advanced decline line has been positive. And that is just a theme that I cannot stress enough. Why? Imagine if you actually saw a correlated day. If you saw a correlated day when there's 90 products on one side of this, people, I'm telling you, the S&Ps will get just absolutely wild and woolly. All right, so think about that. Now, the next aspect I want to talk a little bit about happens to be the bond market. And I'm going to show you why, because bonds will play into this next week huge. All right, so first, let's start with an age-old bond chart. All right, this happens to be the ZB. Now, the ZB itself, it's just oscillating back and forth. Okay, let's take it off percentage view. So the ZB, this is the 30-year U.S. bond treasury. For the most part, what has the ZB been doing? Not a whole lot. But this is one that people look at, or they look at what we call the 10-year. The 10-year is the ZN. All right, they've been relatively flat, which also takes us over to what we call TNX. Now, the TNX is the interest rate associated. Now, the TNX is one of the most heavily, in terms of being watched by institutions, by retail clients. They like to watch the TNX. And again, what the TNX delineates is it says that the 10-year, okay, is sitting right around 2.9%, right in that neighborhood of 2.9%. And we talk about like this threshold of 3%. Every time we hit 3%, we're like, panic. But that's actually not really the object of the affection right now. What is, okay, happens to be this. Now, yeah, I threw a slide together for this. We're getting crazy on you. Okay, what you're looking at right now happens to be, well, the daily Treasury yield curve rates. And you're like, what? If you've never looked at this, it's kind of a lot of data, but I'm a little bit of a quant geek. Data makes more sense than a chart to me. It's a sickness, I tell you. Look at the jump, because when that jobs number came in, it came in hot. Look at the jump right there. Now I just threw a gigantic dot, okay, on one day and a gigantic dot on the next day just to draw your attention. Now, well, let's get a little bit more specific in here and make sure that you guys can actually see this. There's a big jump in the 2-year. Okay. And what's going on right now is you have the 2-year sitting at 2.71%. Then you look at the 10-year, and the 10-year is 2.94%. Notice anything? Oh boy, they're getting really, really close. So there is a point in time where the 2-year, okay, could be the same as the 10-year. So like the 10-year is out here. This is the 2-year over here. And the interest rate, okay, could effectively be the same, or it could even be inverted. And we're getting closer and closer to that, because what we're seeing recently, look, the 2-year is coming up in the rates, okay? The 10-year, it's barely moving. And that's the point to be taken away. So in this next week of trade, we're going to be kind of sitting on pins and needles with this one, because in the next week of trade, and again, you guys can look at that yield curve. By the way, that data, it just comes directly from, well, the U.S. Treasury. And you get that from the Fed as well. But when you start to look at it, all right, let's talk a little bit about asset classes and what could go on. All right, could we get sell-side activity? And let me bring the bonds back up over here so everybody sees them. Could we get sell-side activity in these bonds, all right, at the exact same time as seeing the S&Ps and Nasdaq sell off? And the answer is, well, absolutely. Okay. But if that's the case, where's everybody going? Right? This is the key. Where's everybody going? If you start selling, okay, the S&Ps, and you start selling the Nasdaq, you start selling the bonds, where's everybody going? There's very few products. What are you going to do? You're going to run to the dollar? Okay? They already have. They already started running the dollar. So traders are they're on edge about this, and they're even seeing some of this risk exposure. The other aspect is, I think if we saw people selling both bonds and S&Ps, you would probably see the volatility just ignite to the upside. Keep it in mind. Again, this next week means a lot. There's more economic data, and there's the threat of, China kind of retaliating from some of the tariffs. There's a lot that's, again, going to be going on this week. The one aspect that I want to kind of keep you in tune, though, with, and again, this is the most important thing in the markets right now. It's not so much like techs are selling off. I'm looking for a bounce. I'm looking for this. Okay. And dip buyers, none of that is going to matter. Individual stocks will not matter this next week if bonds sell off with S&Ps. The bottom line is nobody's going to care, and everybody is just going to focus on the fact that there's going to be sell-side activity permeating into the marketplace. And again, this is kind of why I call it a market on the edge. I am not depicting in any way, shape, or form that this market is about to fall apart. And I want you guys to recognize that. I'm not here saying, oh, we're going to fall apart over here. We're displaying right now, well, volatility. So you have a $42 expected move. That's $42 higher, $42 lower. Okay. We just came off, though, a week where we had what? A 30-point expected move. So we see a big expansion in volatility. Okay. We have all kinds of economic factors and news coming out this next week. We have the possibility of China. There's a lot of risk. And the market on the edge, it's not about the S&Ps just breaking down. To me, right now, it's more about the bonds. Okay. Because what we're really seeing, and what I think one of the biggest concerns is, you have to recognize that bonds kind of selling off is typically positive for the financials. Did you see positive movement this week in the financials? No, the financials are absolutely flat. Okay. So again, we're in this big time kind of crossroads, right? Volatility, it is picking up in the marketplace, but just to throw this out to you, we're up to like a 13% on a $42 expected move. Okay. Net, these options, all right, the volatility, it's still really, really low versus some of the risks that I believe are apparent and are on the horizon. this week, I'd be very careful stepping out to sell premium early on in the week. Let things kind of play out. Let things shake out. Again, market right on the edge of efficiency and inefficiency, as we described as well inside of those expected moves. I want to thank everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.